All right, let's continue with some more exercises from Chapter 3. Number 18 reads, the estimated amount of depreciation on equipment for the current year is $8,200. This was the last of the adjusting entries that Chapter 3 talked about. This is a simple entry in that it is always the same every time. You don't really need to think. It's always a debit to depreciation expense and a credit to accumulated depreciation every time. They have to give you the amount, so a debit to depreciation expense and a credit to accumulated. Number 19, the balance in the equipment account is $3,150,000. The balance of the accumulated depreciation account is $2,075,000. What is the book value? So we talk about net book value, and this is the cost is $3,150,000. We take away the $2,075,000, and that gets us the net book value in this case of $1,075,000. So what that tells us is we have already depreciated $2,075,000. What we have left to depreciate is $1,075,000. Letter B, does the balance in the accumulated depreciation account mean that the equipment's loss of value is $2,075,000? And the answer is no. And let me tell you, the equipment could have depreciated even more in the sense that it wasn't well taken care of. It was beat. So technically, it could be depreciated even more. This $2,075,000 is based on, it probably is a 10-year life, and they took 1/10 of depreciation every year. So that's just a very methodical number. It doesn't necessarily mean that it has actually depreciated that amount, but for generally accepted accounting principles, we have to come up with some kind of methodical way. Another example would be real estate. Real estate, we get to depreciate it, but in the Sioux Falls market, for instance, real estate from one year to the next tends to increase in value. So even though we are depreciating it, the actual real estate is appreciating. So there's a certain change. A car, for instance, is another example. They depreciate much faster, and depending upon a person that buys a brand new car, puts it in the garage and never drives it, even though you might be depreciating it every year, though it's never being used, it's not depreciating at all. Or another person buys a car, doesn't change the oil, doesn't change the tires, just drives it 30,000 miles a year. That vehicle is going to depreciate greater than average. So this accumulated is just a calculated amount. All right, number 22. For the year, the balance sheet includes accrued expenses of $604 million. The income before taxes is $849 million. Assuming the adjusting entry for $604 million of accrued expenses was not recorded. Did you catch that? $604 million was not recorded. How much income before taxes would have been misstated? Well, how much is misstated? The $604 million that they didn't accrue. Pretty straightforward. What is the percentage of misstatement? Well, 604 million divided by what was recorded as income is 849. So what is the percentage of misstatement? You're talking a misstatement that's almost, to be very honest with you, it's unrealistic. 71.1%. That's outrageous. That person won't be here doing the accounting anymore, right? You can't be off by 604 million. Anyway, they're trying to get across a point. The next problem that we have is problem 1A. Problem 1A. And it reads, On March 31st, the following data were accumulated to assist the accountant in preparing the adjusting entries for this realty company. The supplies account on March 31st was $56.20. The supplies on hand is now $12.90. And the instruction says journalize these entries. Well, if the beginning balance was $56.20 and it's now $12.90, we need to make an adjustment out of supplies into supplies expense for $43.30. The unearned rent account was $5,000, represents the receipt of the advance payment for 4 months. We got it on March 1st, and it's for 4 months. And remember, the instruction says journalizing entries required as of March 31st. So if we got this on March, and we have now basically expired 1 month, so all of March 1 to March 31st, we got to put 1 month into revenue. $5,000 was for all 4 months. We'll divide it by 4, so we get 1 month of $12.50 out of unearned into earned. Out of unearned into earned. Wages accrued, just not paid. So we are going to accrue it and not credit cash, wages payable, for the amount that they gave us. Fees accrued, just not billed. So we've earned it. We're not getting the cash, so we got to bill it, accounts receivable, for the $16,825. And then again, that depreciation entry, same time, same way, every time. Depreciation expense, credit accumulated for the $4,600. So this problem 1A is a real good recap of the entire chapter. You know, we make an adjustment to the supplies account. We're looking at moving unearned into earned. We are looking at accrued expenses, accrued revenues, and the depreciation entry. If you go back to in your textbook, there is on page 125, and it's a great recap of all of the adjusting entries. The first one is accrued revenues, okay, and it's basically like here, looking at the accrued revenues. The accrued expenses is the second one, right here, accrued expenses. Unearned revenues, taking care of that account. And supplies expense, which kind of goes along with, if you will, the whole prepaid expenses idea. So it's the same type of journal entry. And then the last one is the depreciation. So page 125 of chapter 3 is the recap of all of the journal entries that we focused on, adjusting journal entries for chapter 3. We'll stop there for now, and then we'll get together again for the last 2 problems.